and welcome back to goldstocktrades.com. Today we have a really special guest with us, David Tice. David is the Chief Investment Officer at Ranger Active Bear ETF. It's traded as HDGE. I've first met David when I was graduating high school back in 1998. I went to my first gold show, New York Hard Assets, and I met David there, and we started having a conversation, which led me to follow the Prudent Bear Fund in the late 90s before the dot-com crash. And I also followed it all the way to the housing crash, which David the dot-com and the housing crash, you were ahead of the curve there. You called it exactly. And you started my interest in gold mining stocks because BearX had a large position in a lot of key gold stocks, which really helped the performance. So, David, thank you so much for being here with us today and for giving us some insights into the market and into what's going on currently.
Glad to be with you, Jed.
So the Prudent Bear Fund, we know you started in 1996. There was a couple of hard years there during that dot-com bubble, and we saw this bubble boom and then burst. And talk to us about how you started. First of all, tell us about your background and what got you interested in the financial markets. And what impressed me so much about you is that you really lasted through some tough years, 97, 98 during this bubble, and you kept on staying strong to your principles, that character, and then you eventually were proven right. So I'd like to hear a little bit about your background and the character building that kind of set up so that you could be successful with the Prudent Bear Fund.
Well, thanks for those kind words, Jeb, and we certainly have come a long way. And like you said, 96 to 99 were really tough years. We lost money every year in Prudent Bear, and I'll talk about that in just a second. But my background was I grew up in Missouri, actually was a high school student at Truman High School. So Harry Truman was the hometown child of Independence, Missouri, where I grew up. And so I actually saw Harry Truman go to vote. So Harry Truman was fiercely independent. And I guess I got, quite a bit of my independent streak for that, even though I was named for Dwight David Eisenhower. And my parents were definitely more Eisenhower fans than they were Truman fans. But I definitely got some of the Truman independence. I was a accounting major at TCU and then studied finance. So I was kind of an accounting nerd. And so I tore apart financial statements and ended up providing sell recommendations to Wall Street. And my first Wall Street job that I started my company when I was 31 out of a spare bedroom with a screaming baby next door, and was utilizing 5.25-inch floppy diskettes, and my first computer was what they called a luggable. It was a compact computer that weighed 45 pounds with a little screen like this. It was kind of the predecessor to the laptop. And so anyway, I tore apart financial statements and provided sell recommendations. So again, my independent streak, I felt like Wall Street was filled with bullish recommendations because they were influenced by investment banking. 98% of all recommendations were buys. People were not really looking under the hood to see what kind of accounting games might be played. Essentially, companies were taking big charge-offs and then were burying subsequent operating expenses against those charges in order to create earnings per share growth that was palatable to Wall Street, and competition would be picking up and overlooked by Wall Street. And so I actually had clients like Michael Steinhardt and George Soros and Julian Robertson and Fidelity, and went to New York City and carried my luggable and ended up getting inside some pretty heavy rooms. And then I started the Prudent Bear Fund in 1996, and I took that negative accounting acumen and trying to find the glass being half empty on these companies, and provided a ability for individuals to get short in a professionally managed portfolio, because up until then that really wasn't available to them. And then individuals could essentially create their own hedge fund by utilizing Prudent Bear for short exposure with their own long side of their portfolio, which could be another PM or their own individual stocks.
Well, what was so unique about you, David, was not only did you know how to find the stocks to short, like Tyco at the height of the .com bubble, where you got on the front page showing that Tyco, there was some accounting issues there. You also saw gold as an important, vital, and gold miners as a vital aspect of the Prudent Bear Fund. So usually people that are looking at accounting and balance sheets, they look at some of these gold miners, especially, the developers and the explorers, which are losing money. They stay away from that, or they even short that. But you included that within your portfolio, and that's why you had, especially during that cycle from 2001 to 2008, you had all those really great gold stocks that were really plus, those hedges on those overbought, overvalued stocks. So how did you know how to do that, or what made you go against that thinking with the balance sheets and going into these developers and explorers?
So my background, like you said, was kind of the accounting gumshoe and looking at footnotes, but then also I was blessed by having discovered the Austrian School of Economics, which is Ludwig von Mises, Murray Rothbard, Joseph Schumpeter. And so I ended up realizing that Federal Reserve extension of credit would create short-term prosperity, but then longer-term pain. And through the 96 to 99 period that we talked about briefly before, that was a painful period, but I was bloodied but unbowed. And I realized that this too would end, and this was simply, pumping up a bubble. And one of the key principles of the Austrian school is the magnitude of the decline is proportional to the excesses created during the prior boom. And I hadn't realized it till much later how really that mirrored Newton's law. For every action, there was an equal and opposite reaction. And if you look at people that are, I think, rational in understanding markets, they get that. And they don't feel as if trees will grow to the sky and that you can just print money and get yourself out of a bind and just create, dramatic excesses in fiscal policy with taking on massive amounts of debt, et cetera. And therefore, I was a person who understood history, and I understood gold being true money, where fiat money was not true money. It was just an extension of credit. And therefore, I saw the massive injections of credit for Y2K in the year 2000, and saw that gold had been in a long period of doldrums, and therefore would likely increase dramatically. And then if you look at the miners have operating leverage, and so figured out that they're likely to go up a lot more proportionally than the bullion price. And in fact, they did. And as you adeptly pointed out, my inclusion of gold mining companies inside Prudent Bear to exposure between 5% really helped save our portfolio and allowed us to generate a really good track record for the 10 years ended '08.
Now, when I started my blog was after the credit crisis. And I kind of spent my first part of my career just learning and investing. And then I started my blog around 2000, beginning of 2009. That's when you sold the Prudent Bear Fund, at the height of the credit crisis to Federated. And then you went on to do other things like financing some inspiring movies like Soul Surfer with Bethany Hamilton, the Hawaiian teen surfer who lost her arm in the shark attack. I stuck on with the gold stocks and suffered a major correction in my portfolio. And you were able to time that to sell the fund at the height of the market. How did you know that? How did you have that sort of understanding? And now you're coming back. How do you know how to sort of the timing is impeccable?
Well, there was a little bit of luck in that, Jeb. I felt like, frankly, the market would continue down in 2009, 2010. I didn't think we'd get out of the woods, but I wanted to diversify my, career. Frankly, I knew being a public bear, kind of put a target on my back. And therefore, I wanted to cash out to a degree to prevent any kind of people don't like bears, and sometimes regulators don't like bears. And even though we were squeaky clean, I just wanted to diversify my portfolio. And I did feel like there were other things I wanted to do in my life. I was very excited to be involved with Bethany Hamilton and Dennis Quaid and Helen Hunt and Carrie Underwood to get that movie to the big screen. And I feel like we influenced a lot of people's lives with that film.
So gold's been, as you know, the gold market's been in a correction since 2011 to 12. The miners are at, they've rebounded recently with this pandemic. We've seen a massive decline in the stocks, but we've seen a little bit of a relief rally. Do you think that this is going to be like 2008 with a V-shaped reversal, or do you think that this could be something like 99 or after the dot-com or the Great Depression, where it might be a little more extended at this point?
So I look at four different declines. We can look at 1987, we can look at 2008, and we can look at 2000 to 2002, and we can look at the 1930s. So 2008 as well as 1987 were sharp declines, pretty much followed by rallies, and we were off to the races again. I don't think we're in that camp at all. I think this is more likely to be a 2000 to 2002 period where there were several different declines, and we had 3 years of down stock markets, and therefore it was not back off to the races quickly. Also, in the 1930s, we ended up having the first decline. We ended up having a 48% rally that actually took 5 months. And then we had a protracted period of down days in the market. Again, there were some rallies throughout that, but eventually the market was down 86% from that interim high after that first crash.
What do you say to people? Because I'm meeting so many investors that are returning to the gold sector that are looking to hedge a little bit. They're so levered into real estate and the stock market. What do you tell them to do now?
Well, I do feel like short exposure is appropriate. First of all, I really think they should invest and smart people, they should listen to shows like you that bring good guests and good insight to the equation. They should know themselves about how optimistic. We all want to be optimistic, but when you're dealing with your money, it's appropriate to be rational and objective. And you might look at the fact that we have NASDAQ up for the year right now when a lot has changed. Certainly, looks like we have 30 million people unemployed, and frankly, we don't know how quickly that's going to come back. We're opening up the economy, but a lot we don't know. And Howard Marks just recently wrote an article talking about how we just don't know a lot. We aren't sure what's going to happen in 45 days after we reopen the economy. And I think those people that feel like this is going to be a V and we're going to be off to the races again are not being reasonable. And we don't know if there's going to be a second wave in September and October, and if that could be more significant and lethal than this last leg. So I'd say some short exposure, some less exposure to traditional longs, and I've been a believer in at least 10% in gold or silver, and both, frankly, makes a lot of sense. And I think the mining companies makes even more sense, because whenever you've had a period of this aggressive Federal Reserve action like we've seen, gold stocks do very, very well. Rick Rule has talked about the rallies generally being between 180% and 1,200% is how the rallies have scaled historically after these big, Fed rescue efforts.
So, after the 1929 crash, we had a significant rally and then a second leg down. Do you think that maybe we could be going or recently have gone through a possible relief dead cat bounce?
Well, Marcus, in fact, Bob Farrell, the famous strategist, technician from, I guess, the 70s and 80s at Merrill Lynch, he has 8 rules of markets. And this was just pointed out by someone at the Malden conference, David Rosenberg, I think it was. And he talks about the fact that there's generally, when there is a bear market, there's always this first leg down, which tends to be pretty precipitous, and then a retracement rally, and then a protracted decline to the eventual low. So I think this is not rocket science. In a crash, markets get oversold and markets sell off, probably disproportionately, because everybody is, throwing out everything, and there can be some overreaction short term. And then there is always a retracement rally, and technicians like to look at Fibonacci, which is a mathematical series, and that retracement rally can be between 38% and I think 63%, but sometimes it goes as high as 70%. So really, we had retracement rally, I think, of about 55, 56%. So that should not have been unanticipated.
Today, we're speaking with David Tice, who's the Chief Investment Officer at Ranger Active Bear ETF. The symbol is HDGE. Mr. Tice is the founder of the Prudent Bear Fund that, from 1996 to 2008, consistently beat the S&P 500. David, thank you so much for being here with us today. And we hope that to have you back on for giving us updates. And I hope you can continue to share and educate, and like you did for me back in the late 90s, which started my interest in precious metals and money, and sort of seeing looking at the other side. Sometimes the mass media is selling us and taking a contrarian approach, and sometimes you have to be for a little while to eventually be right. And I've seen that in your career, and I've seen that in my career, and that's what I tried to explain to my subscribers. And in gold, sometimes we've had to be wrong, but eventually, as we see now, it's coming back as a safe haven. And I thank you, David, for your career, for your education, for teaching, and for your humility always to be there to speak to investors that are trying to learn more and think differently.
Glad to be with you, Jeb. I look forward to seeing you next time.